I think this is a natural reaction from what we've seen through central bank meetings for the last few years. They announce a big policy, then they sit back and wait for it to actually see be reflected in the markets and to assess how it's going. So there was very low expectations for anything to happen yesterday. That's what we got. Nothing really happened. The market didn't react. I think people tend to focus on what's happening around the world, whether it's the US earnings outlook, whether it's the direction of the euro, the dollar, and actually rely back on fundamentals. And that really hasn't changed. We're still in a period where we're seeing a lot of volatility and there's still concerns about the pace of global growth. I think for us it is a case of things are getting a little bit better, but just not as fast as we would like them to.
So you see the meeting as basically a non-event, but one thing did happen that was different from the previous meetings. We got more information on the corporate bond purchase program there, specifically what the ECB can buy in the investment grade space. Given the flows we've already seen into corporate credit just on the sheer announcement, is this going to have any big difference?
Yeah, I think the biggest takeaway from that one was the size of what they could actually purchase. So they're saying they do up to 70% of issuance, they're doing it from 6 years to 30 years maturity, and that really saw a lot of analysts re-estimate what they thought the size of the bond market they actually could buy. So it's going to be about $5 billion a month, roughly on terms of that extra $20 billion they're going to buy in terms of QE every month. That's bigger than what many people thought, and that does add a lot more power to what they are going to do. I guess we'll actually find out in June what they start, where those maturities sit, and that's always the problem. You're kind of second guessing what the ECB is actually doing. We saw that when they started buying sovereign bonds, but it does show that they are becoming more inventive with what they're willing to do to support the market. The question really is, are they effective? And that's where the markets are worried about, that these central bank policies are becoming less effective in how they're actually stimulating the economy and stimulating the market. And that's why Mario Draghi is saying monetary policy is great, but you need that structural reform to go with it.
And another big unknown in the efficacy is how it impacts banks, because of course we know the negative impact of the negative interest rates, but then they say we're improving credit conditions and terms here. However, banks have enjoyed a little bit of a pop-up here the last 3 days, but not a good run of it for the start of the year. How do you view banks for the rest of the quarter?
Well, I think the bank's sentiment in Europe is actually not as bad as the market's pricing in. So you have seen some positive steps towards the bank in Italy with the formation of a fund to bail them out. You have seen a lot of the talk about the ATI ones and that start to come back a little bit. So I think the fears over the banking sector in Europe in particular have started to recede a little bit. And as we look for opportunities in Europe, and we think there's a lot of upside, we do look for the improving credit growth. We do look for the consumer demand keeping through. You do have that demand for loans there. You do have a low oil price. All that should support the consumer and the rhetoric around that. We think that will feed slowly into what you see in the financial sector.